US markets are mixed as they digest the US court ruling that the Trump administration's tariffs were imposed illegally. Australian business indicators were a mixed bag in Q1. The Reserve Bank of New Zealand governor says a July cut is not a done deal, and the Bank of Korea cuts with more to come. That's coming up in our 5 Things in 5 Minutes on Friday, May the 30th. And then in part 2 of a deep dive interview into Singapore's new safe haven status, ANZ's head of Asia research, Khoon explains how the city-state avoids being labelled a currency manipulator by the United States.
Singapore will never be able to meet all 3 criteria to be labelled one. So yes, Singapore does run a large overall current account surplus, but it actually runs deficit against the United States.
But first in 5 and 5 with ANZ, I'm Alex Tarrant standing in for Bernard Hickey, who's on a well-deserved break from now through June. US markets were mixed overnight as initial optimism off the back of Nvidia's results was met with uncertainty over the direction of US trade policy. The US Court of International Trade yesterday ruled that most of the Trump administration's recent tariffs were illegal due to the use of the International Emergency Economic Powers Act to justify their imposition. However, as ANZ economist Bansi Madhavani explains from London, the administration will appeal the ruling.
We've had several policymakers talk about how they have a number of different options. They're also maintaining that nothing changes with the ruling and that they intend to continue talking to trading partners and negotiating deals in coming days and weeks. The legal timeline of how the appeals process could look like stretches anywhere between next few weeks to next few months. So that is an added level of trade policy uncertainty.
As of 4 a.m. Sydney-Melbourne time, the S&P 500 was up 0.15%. It had been up 1% in earlier trade. US Treasuries gained as traders picked the FOMC would make 2 rate cuts this year. The yield on the 10-year was down 5.5 basis points at 4.424%. Gold was up 0.77% at $3,348 an ounce, while West Texas Intermediate futures were down 1.5% at $60.87 a barrel due to concerns of weaker Chinese demand. The US dollar index was down 0.6%. The Aussie was trading up 0.4% at 64.48 US cents, while the Kiwi was up 0.25% at 59.82 US cents. Number 2, US Q1 GDP was revised overnight from an initial 0.3% annual fall to a contraction of 0.2%. Bansi says while consumer spending growth was revised lower from 1.8% to 1.2%, there were other offsets leading to the less negative result.
Net exports, as expected, continued to detract from headline GDP, given that imports surged amid front-loading of demand. There was an upward revision to the investment side, which offset some of the headline weakness. Our sense is that the early indication is that growth is set to recover in the second quarter. The Atlanta Fed's GDP Now estimate shows that growth is tracking at 2.2% on a seasonally adjusted annualized basis in the second quarter.
Number 3, in Australia, business investment data this week was a mixed bag for the first quarter, according to ANZ senior economist Adelaide Timbrell. Private capital expenditure fell 0.1% compared to market expectations for a 0.5% lift. CapEx plans for 2025-26 were also weak. On the positive side, though, private construction activity rose 1.7%, with non-residential work up 3%.
Overall, we see this information as well as the weaker household consumption measures in Q1, bringing our GDP growth forecast down to 0.4% in the quarter for Q1. This also takes into account that drop in public sector investment, which was indicated in the construction work done data.
Number 4, Reserve Bank of New Zealand Acting Governor Christian Hawkesby has said a rate cut in July is not a done deal, with the central bank taking considered steps through the cycle. Meanwhile, headline business confidence tumbled 12 points in May to plus 37, according to ANZ's Business Outlook. ANZ New Zealand Chief Economist Sharon Zollner says there were positive movements, though, in the month, especially as the month went on, for profit expectations in particular.
They're a lot higher than they were straight after all that tariff noise, though not back where they were in March. But what's interesting is that although profit expectations have bounced back a lot, investment and employment intentions have bounced back to a much smaller extent. The way I'm thinking about that is that you might have an estimate of what your profit is, but if you're very, very uncertain about that, then you're less likely to invest and employ. And something the Reserve Bank talked about a lot this week was the potential chilling impact of uncertainty on investment and employment, and whether that might mean they end up needing to do more with interest rates to support the economy.
Number 5. The Bank of Korea cut its policy rate 25 basis points to 2.5% yesterday, citing the impact of US tariffs. ANZ economist Crystal Tan says while that was expected, the surprise came in how low the central bank cut its 2025 growth forecast.
They're now expecting growth of just 0.8%, which is almost half of their previous 1.5% estimate. Now, the downgrade is due to several reasons, including a slowdown in the construction sector, weaker exports, and a more modest recovery in private consumption. Now, with such weak growth and inflation under control, it looks like more rate cuts are on the horizon. The messaging from the policy meeting was pretty dovish, with 4 out of 6 committee members, aside from the governor, supporting another rate cut in the next 3 months. So no change to our forecast for a further 25 basis point cut in the third quarter.
Crystal Tan there. Now in part 2 of a deep dive into Singapore's newly found safe haven status from earlier this week, ANZ's head of Asia research, Khoon explains to Bernard Hickey how it is that Singapore doesn't meet the US Treasury's definition of being a currency manipulator.
The US government has been concerned over the years about so-called manipulation of currencies that would somehow maintain current account surpluses between a particular country and the United States. And Singapore has that current account surplus with the United States. Do you think there's a risk here the US Treasury could point the finger at Singapore, given that it actually uses the currency for monetary policy reasons?
The US administration understands the unique framework that Singapore operates for its monetary policy. The US Treasury in their semi-annual report does have Singapore in its monitoring list, but it is very unlikely for Singapore to be labeled currency manipulator because Singapore will never be able to meet all 3 criteria to be labeled one. So yes, Singapore does run a large overall current account surplus, but it actually runs deficit against the United States. So that is the one criteria that will prevent Singapore from being labeled a currency manipulator. But nonetheless, the US Treasury has consistently highlighted the large current account surplus that Singapore runs and has for quite some time advocated for the Singapore authorities to allow more meaningful appreciation of the real exchange rate for Singapore in order to address that current account surplus.
One factor that can make a reserve currency is a very big and liquid market for government bonds. What's the story with Singapore?
Well, Singapore in this instance will not be able to meet that criteria because being a small city-state, there is so much that it can issue bonds for, particularly when the country runs a fiscal surplus. So in actual fact, the Singapore government does not actually need to issue any bonds because they are self-financing, but they do issue bonds so that there can be a local yield curve in order for corporate bonds and the like to be priced off. So that's the main reason why the government actually issues bonds. And also for the purposes of the CPF, which is the compulsory savings in Singapore. So therefore, the size of the Singapore bond market will always be limited. And I guess in some instances that creates some kind of scarcity value, but that also limits how much money can actually be allocated into Singapore in the first instance. So, whilst we could be in a period where there's a lot of capital reallocation as investors maybe look to de-risk or shift some of the allocations away from the US, only a small part of that realistically can be absorbed into the Singapore market given its small size. The vast majority of them still need to be redirected to the other major markets.
Khoon there. I'm Alex Tarrant, standing in for Bernard Hickey. We'll be on a break from now through June. That was 5 and 5 with ANZ for Friday, May the 30th. Catch you next week with analysis of Australian retail spending and New Zealand consumer confidence.
This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.